President Trump's global tariff announcement has wiped out $6 trillion of U.S. market value in just 2.5 days of trading. The S&P 500 is flirting with bear market territory, while major Wall Street banks are warning of increasing recession risks. I'm Maggie McGrath, a senior editor at Forbes, and here to discuss the market's volatility and the potential for major economic ramifications from Trump's tariffs is Spencer Hakimian. He's the founder and chief investment officer of hedge fund Tolou Capital Management. He's also a Forbes 30 under 30 lister. Spencer, thanks so much for joining us today.
Yeah, I appreciate it.
So yesterday, Sunday, when futures trading opened, you posted a video to social media saying you were looking at how badly futures were down at the time. And of course, markets opened Monday trading also in the red. But you said we are risking an economic catastrophe like nothing we've ever seen before. Worse than '08, worse than the beginning of COVID. Why do you say this?
To me, it's fairly obvious. I mean, we cannot arbitrarily reroute and rework global supply chains, global trade. These are things that are literally almost a century in the making. And to think that we can somehow just magically change all of this over a single weekend while the president golfs, frankly, I just do not think this is possible. And I think we're being extremely, extremely careless with our economy. And the consequences are going to be felt by people that unfortunately may start losing their jobs, just as we saw in Detroit over the weekend as Stellantis started laying off people. So I say we risk an economic catastrophe. First, because I don't even agree with the idea of what we're doing. But second, because even if I did agree with it, the pace and the utter chaos of it will almost certainly lead the economy into a recession. You can talk to any small business you want right now. Nothing's happening if they are relying on exports. They cannot function under this. What do we think is going to happen to them? So that's why I made that video.
There's a lot to dive into from what you just said, but let's talk about with the tariffs. They're sweeping. It is dozens and dozens and dozens of countries, and the White House has even said some 50 countries have already contacted the Oval Office to negotiate. As you look at what President Trump announced, are there certain countries, certain tariffs that you see as more damaging to the U.S. economy than others, or is it just the breadth of what we're seeing that's so damaging?
But of course, there are some tariffs that are a lot more damaging. And I just want to go back to that video I made. I just want to clarify, I agree with the president on some of these tariffs. I agree that we should not be 100% reliant on India, China, and Ireland for pharmaceutical manufacturing. I agree that high-end chips should most likely not only be made in Vietnam. Where I passionately disagree is, are we really going to fight to bring back sock manufacturing from Cambodia? Are we really going to fight to bring back sneaker production from Vietnam? Are these things worth fighting over? And, we are stretching ourselves thin. If we want to go out China over some unfair trade practices, which they uncertainly do, if we want to even go after, let's say, Germany, where they may be unfairly tariffing our auto companies more than we're tariffing, let's say, Volkswagen, fine. But to be going after everybody at the same time, so much that we're tariffing countries that don't have humans on it. I mean, it's almost impossible not to laugh when we talk about this. This has to get more measured. This has to get more targeted. There has to be a clear and legitimate plan. It has to be spoken with big business leaders, with small business leaders. There has to be some type of message conveyed that we are doing this, we're doing X for Y. To simply just pull out a chart that looked like a high schooler made and to say we're tariffing every country in the world based on some arbitrary numbers that we made up, this is insanity. We're going to lose trading partners. We're going to lose allies. People that want to work with the United States are going to have no choice but to gravitate towards China. Is that what we want? Does that make us stronger? Does that make them weaker? It does not make sense to me.
When you talk about doing everything all at once and how that just can't happen, you used in your video a really interesting example of an Intel factory. And I wonder if you could talk a little bit more about that, because you say you agree with the president in some of these cases, but the idea of reshoring so much business production and manufacturing in the US, that is something that takes time. Can you talk about the average timelines that would be more reasonable and perhaps wouldn't cause such a market reaction?
So the president said that we will have all these factors up and running in 1.5 to 2 years. Is just factually and is impossible. I'll give a good example. The previous president, President Biden, as part of his CHIPS Act, gave a massive subsidy to Intel, the American chip manufacturer, to build one chip factory in Ohio. One. Okay, they broke ground February of 2022. You know when that's going to be complete? As of their last guidance to Wall Street, Q4 of 2030. We're talking almost 9 years to build one factory. Granted, chips are a little bit more complicated than, let's say, building, a t-shirt manufacturing plant. But nonetheless, it just shows the gravity. One plant could take a decade. To say that we can somehow do this in 2 years is so irresponsible for somebody to say something like that. And beyond that, I think this is exactly what Wall Street is anxious about, not just the breadth of the tariffs. This is completely unreasonable. This is so easily disprovable what they are talking about, that we're losing credibility every time we make a comment like this out in the public. And then to answer your next question, in terms of the timeline, it really would vary, but I mean, think about anyone that's even built a single family home in the United States. There's delays, there's permitting, prices go up, vendors quit in the middle, you have to find new ones. The best case scenario, which is not going to happen, but if it did happen, we'd be looking minimum 5 to 7 years. A more realistic scenario, if you were to ask me, is 10 to 12 years. And I've seen some credible people, but they are bearish. They've said this could take a full generation. This could take 25 years. I mean, look how long it took Germany to be built after World War II. It didn't happen overnight. It took 20 years.
Those are some sobering numbers. So I do have to ask, Bill Ackman said over the weekend that he's calling on the White House to institute a 90-day pause, just a timeout to lower the temperature and I think to better negotiate some of these terms. Would a 90-day timeout in this situation help at all, given some of those timelines that you just outlined?
And anything at this point would help. 90 days would help. 30 days would help. 60 days would help. A full year would help. Anything would help. I agree with Bill Ackman here that we have to pause this, because this is going to go into effect. And as of now, in under 36 hours from now, the world economy will be shut down. You cannot put a 50% tariff on every country we depend on for exports and expect that to not be inflationary and anti-growth immediately. This is an emergency. So I agree with Bill. Some delay, just for some clarity. We have to understand, how do you actually expect us to do this? How do we replace the tomatoes and avocados from Mexico that Walmart depends on to sell their produce? How do we replace seafood from Japan immediately? These are not political questions. These are simple, basic human questions. And I hope that cooler heads will prevail in the White House, because frankly, they have to.
I think around the time of President Trump's election, re-election, and inauguration, there were some folks who were finding comfort in his hiring of Howard Lutnick and Scott Bessent, longtime Wall Street veterans. What is Wall Street's view, and what is your view of Lutnick and Bessent now? They're in the administration. Are they the cooler heads that could prevail here?
If we go back to right after the election, I should say, and Wall Street, at least our sector, got pretty happy about seeing specifically Scott Bessent and then to a lesser extent Howard Lutnick get chosen to be the administration. It reminded us of when Steve Mnuchin and Gary Cohn were put into the first administration. And Steve and Gary were really counteracting forces to the more radical voices on trade. I'm talking about in the administration, such as Peter Navarro. There was Steve Bannon last time around. There was, a whole host of actors. So Wall Street took it as a comforting sign that the president chose some traditional, more traditional types of people to be in this administration, on the idea that they could counteract some of the people that may have had more radical ideas. That's been an utter disappointment. Scott Bessent seems like he has absolutely no leverage in this White House. He didn't even know why Canada and Mexico were exempted from the chart last week. Howard Lutnick, I know there was a verbal dispute between him and Bill Ackman last night on X. Every time he goes on TV, it just seems like he makes a comment that just, frankly does not make sense. He was talking about how Europe doesn't accept our beef because our beef is stronger than theirs. What does that even mean? It's not even you can't even not laugh at a comment like that. So I think as of now, Wall Street is a little bit disappointed in the lack of sway that Scott Bessent and Howard Lutnick have had. Hopefully things can turn around, but as of now, it seems like Bessent doesn't have any leverage in this White House, and Lutnick doesn't appear to be making anything better, if you want my honest truth.
What would it take to turn this situation around, in your opinion?
So, in my opinion, and I'm going to speak in terms of the economy, because although, I am an investor myself, first and foremost, I'm a citizen of this country, so I want to talk about the economy. I think we have to take some kind of off-ramp here. Frankly, it'll most likely be ceremonial, just as it was in 2018. Maybe China can commit to buying more soybeans, as an example, although never really materialized. Maybe Japan, who already has a lower tariff rate than we do, agrees to, have a lower tariff rate than us, which is already what's happening, so it doesn't really matter. Countries like Zimbabwe that don't really import anything from us can maybe agree to make their tariffs zero. But I think for this to get fixed, the president wants to take some kind of victory. He's not going to get anything of substance, if you were to ask me, because if he was, he would have got it in 2018. Or frankly, President Biden, that continued a lot of his tariffs, would have got it in 2021, 2024. I don't see a material win coming, but I think we can arrive to some ceremonial win where we can just take an off ramp here. And if we can, and I stress, if we can do this very quickly, we do not have to go into a recession here. My anger on that video on X that we spoke about was, this is self-induced. COVID was an act of nature. 2008, yes, you could say it was a policy error, but there was hundreds bad actors, and this was brewing over years. This is a single point of error, and this is one person can choose to stop this tomorrow. That's what is frustrating about this. So I think that if we are to turn this around, it's going to be over some kind of indefinite pause about tariffs. And I just want to say, even in that indefinite pause scenario, I think some credibility is unfortunately lost. Every 30 days since January 20th, we've been doing this. So I think in terms of equity markets, we're going to have to price in a permanent Trump discount, quote unquote, because this can happen at any time. This is like a volcano that can erupt at any point in time. So, but I still think we can recover most of the economic losses that we look like we're going to suffer if we can get through this sooner rather than later.
You talk about a permanent Trump discount in the market, or at least for the time being. I was looking at the VIX this morning, and it is just surging, which of course is an indication of market volatility. Do you predict market volatility for the rest of 2025, or what's your view there as an investor?
So as an investor, we tilt towards volatility being a norm. We tilt towards volatility always being there. We're always invested, although that's not actually true. It still pays to invest as if volatility is always there and be both risk on and risk off at the same time. In my personal opinion, as long as this threat of tariffs stays in place, as long as Congress does not take back their constitutional right to impose tariffs, not the president. This was a right that was given to the president in the 1970s and is not an absolute right by any means. This is an emergency measure that looks like it's being pushed a little too far. As long as this potentiality in the market is there, that at any morning we can wake up to 50% tariffs on Vietnam or on China, on anybody, I think the VIX will stay elevated. I don't think we'll have a 50 handle on the VIX at all times, but I think the baseline of the VIX from 2024, the baseline has gone up a little bit materially for the time being.
As we talk about other market indicators, you've built your firm using AI models that can predict the price fluctuations of assets, including gold and crypto. And these are two asset classes that are really interesting right now. Gold is surging. And crypto has had day-to-day increases, but year to date is down. And I want to ask you, these two asset classes are traditionally seen as hedges against the broader equity markets. What do you make of these two asset classes and the way they've been moving recently?
Yes, you're right. They are seen as hedges. I personally disagree with that. Gold is absolutely a hedge for risk-off events like what we've had since, let's say, February 19th. Crypto is a lot more correlated to equity markets, especially Bitcoin. It's pretty well correlated to the Nasdaq 100. With that being said, the correlation, if you want to go back to, let's say, 2018, 2017, was nearly 100%. If stocks are up for the day, Bitcoin was up for the day. If stocks were down for the day, Bitcoin was down for the day. Now it's gone to about 40%. So that is a sign that Bitcoin is becoming a little bit less correlated to the equity market. But as we've seen, Bitcoin is down this year and stocks are down this year. So and gold is up double digits this year. So it's not quite yet the perfect hedge. Nonetheless, we still own it. And the reason that we personally own an asset like Bitcoin is that it's actually somewhat counterintuitive. But because Bitcoin is more volatile than equities are, you can own less Bitcoin to get a similar reaction that you wanted from equities. Let's say if you needed $10 in equities because you expected equities to go up 1%, you might only need $5 of Bitcoin because Bitcoin might go up 2% in that exact same scenario. So that is kind of the reason why we have an allocation to Bitcoin. And yeah, I think gold is behaving exactly as you'd expect it to behave. It's why it's one of our favorite asset classes to own on a permanent basis, not just now, because you don't know when these risk-off events are suddenly going to materialize. But when they do, assets like stocks and crypto tend to fall. Safe havens like gold and sometimes bonds tend to rise. So we like to have a balance so that we are not exposed. And it looks like it's working out well. I mean, we were flat last month and equity markets were down 7-8%. So I think there's some proof to the method.
So far, so good for you. But hedge funds overall are facing some of their biggest margin calls since 2020. What does that signal to you?
So I cannot speak for every hedge fund in the world. Hedge fund is a term as vague as sports. There's billiards and there's kickboxing, right? Those are both sports, but they are very different in reality. But a lot of hedge funds tend to be operating on strategies that are low nominal volatility, which just means that overall the idea is low volatility, and then they leverage up those investments, meaning they borrow against it. So if they have, let's say, $1 of equity, they might borrow $4 from a lender and they have $5 position right there. And that position tends to work well when markets do well, which is most years. But when markets don't do well, that leverage works against you in the other way. And a 5% loss quickly becomes a 25% loss. And most hedge funds, at least, are designed to not lose money. They're not really designed to make the best returns. It's a very different clientele, pension funds, high net worth investors. It's people that are much more worried about not losing their money rather than, making 25, 30% in a year. So hedge funds tend to stop out of trades very quickly if their strategy goes south because they cannot tolerate those losses and, they risk redemptions if they get too big.
Now, in your video that you posted yesterday, you talked about how in this environment, you will generally be okay, your firm will generally be okay, but you are worried about the U.S. consumer and small businesses, which we touched on briefly at the beginning of this conversation. But I just want to emphasize the point. What do you see happening to U.S. small businesses in this moment right now?
Okay, this is all subject to a lot of uncertainty because, we can hang up off this call and this can all be reversed. And then, but if we're going to go on the assumption that what is in place now is going to stay in place, the consumer will be hurt, Inflation will go up in the short term. Unemployment will undoubtedly rise. People will tighten their belts. People will get laid off. And just as another comment, if you think that you are somehow going to get a cheaper mortgage on your house because the 10-year is falling, you have to consider the other side of this equation, which is credit spreads. You and I are not the United States government, all right? Banks lend to us because we have a job, we're employed, we have a wage, and that wage can satisfy that mortgage. If we go from employed to unemployed, we are not a creditworthy borrower at that point. As an example, the 10-year fell in 2008. Mortgage rates didn't fall in 2008. Good luck trying to get a mortgage back in 2008. In March of 2020, the 10-year nosedive. You couldn't get a mortgage back then. So it is not just about the 10-year yield. The 10-year yield is the United States government borrowings cost. In a normal time, yes, we are all in a way pegged to that. In an abnormal time like now, there is no guarantee that we are going to get lower borrowing costs because the United States government is getting lower borrowing costs. In fact, it could be quite the opposite. So if everything lasts, I'm bearish on the U.S. consumer, unfortunately.
Bearish on U.S. consumer and therefore U.S. small businesses?
Absolutely. U.S. small businesses are very dependent on domestic consumption. Think about your local, your bagel and coffee store. They're dependent on that person that's going to work in the morning that stops in and gets himself or herself a bagel and a coffee. What if he or she doesn't have a job in 2 months? That sale dries up. The economy is all interconnected. That is what we have to understand, right? One of my frustrations in that video was a lot of people are saying, well, the stock market, Wall Street isn't Main Street. Wall Street is pricing in what's going to happen to, what do you think Wall Street is pricing in? It's pricing in what is expected to happen to Main Street in this time period. Stocks started falling early in 2008. Unemployment didn't really begin to rise until the end of 2008. People were saying the same comments back then. Wall Street isn't Main Street. And to an extent, I agree with that, but I believe that is an unfounded comment based on history.
Spencer, we've covered a lot of ground. Is there anything else on your mind as it relates to tariffs and their economic impact that you would like to share with the Forbes audience, or maybe, if we're lucky, anyone from the administration who might be watching?
The only thing that I would say is we have to have compassion. I understand why people were angry in 2021 to 2025. I fully understand it. I fully understand why, although the unemployment rate was, 4% on paper, many people had no hopes for getting a job and they quit the labor market. My biggest worry is that person that, for whatever reason that is not his or her fault, could not get a job at 4% unemployment rate. They are doomed. They are doomed at 8% unemployment. It's not funny. It is not a joke. We shouldn't be talking about, winning golf rounds. People's livelihoods are in the balance here. And problems that were problems at 4% are such bigger problems at 8%. If you thought 6% inflation was bad in 2021, wait till 2022, I should say, wait till there's, God forbid, if there's 6% inflation with unemployment rising this time around, then you'll see a problem. Then you'll see a real problem. So all I'm urging the White House is have compassion. Many of the people that voted for you guys because their economic situation was dire. Please do not make it worse for them. I will be okay. Somebody like me, we will trade around this. Even if I lose 10%, life's going to move on from me. It is the person that cannot afford to miss a paycheck. That is who is at risk here. It's not me, it is them. So please, I urge the White House, think about those people. Many of them voted for you to help them. Please think about them.
Spencer Hakimian, founder and chief investment officer of Tolou Capital Management. Thank you so much for joining us and for those very important words and also analysis. We really appreciate your time.
Thank you, Maggie.